You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Next, AO, Tesco, Cranswick, Sainsburys, and our US company of the week is Nike. Sam, shall I kick us off with Next?
Yes, a favourite of the show.
Absolutely, and one that continues to deliver. It had its Q4 trading statement out last week, with Next full price sales rising by 10.6% in the 9 weeks to the 27th of December, ahead of the group's previously upgraded guidance of 7% growth. This was driven by better than expected growth in the UK and overseas, with the latter up 38.3%. Due to the strong sales growth, full-year pre-tax profit guidance has been upgraded and is now expected to grow by 13.7% to £1.15 billion. Net debt, excluding lease liabilities, looks set to grow by around 100 million to around 700 million, and share buybacks over the year are expected to total around £100 million. Next intends to return £3.60 per share through a special dividend. For the upcoming 2026-27 financial year, pre-tax profits are expected to rise by around 4.5% to £1.2 billion. But perhaps we should expect that to be revised. The shares rose 3.1% in early trading. And when we come on to the valuation, Next currently has a market cap of £16.6 billion and trades at 17.5 times forward earnings with a prospective dividend yield of 2.6%. I thought these were excellent results, and it was the third upgrade in 5 months from Next. Very encouraging with the overseas sales growing well, up 38.3% and accounting now for around 18% of total group revenue. Most of the overseas is Europe and the Middle East, and then the rest of the 82% is UK and Ireland. I think Next is fantastic, probably the best retailer in the UK, and it has been that for a number of years now. I think it's continued to impress us since we started covering it around 5 years ago. I'm fairly anchored to the price of, I think it was about £50 when we started covering it, and it's now up closer to that kind of £150 mark. So, and it's always, as we've seen, sort of smashed expectations, and you almost think that they offer deliberately conservative ones for them to beat. But it has done incredibly well. I think it has benefited in many ways from the death of the rest of the high street. So you think back kind of, well, probably 10, 15 years ago, maybe going back in 20 years, you'd have sort of Burton, Dorothy Perkins, Topshop, all of those companies. They've all gone, and some of them have been sort of consumed into online-only operations by ASOS and Boohoo, which, as we know, haven't done very well. And it feels like it's almost consolidated the market for Next. And Next has had that kind of unique hybrid sort of online but bricks and mortar operation. We know it has that online platform that other online retailers or hybrid retailers use. So it's adapted fantastically well. Personally, I think it's got to the point now where there is more risk involved with it, given that valuation of 17.5 times forward earnings, and that we are really fairly saturated in the UK. I appreciate they've been able to put up some of these figures. However, quite a lot of that is going to be based on whether they're going to be able to continue that overseas growth, which they may well be able to do. But I think that is less certain and where more risk is involved. Certainly their presence in the US, that would be something, if they could crack that then you think, well, 17.5 times forward earnings looks very cheap, but that's a big if. And you've seen lots of UK companies that have been fantastic operators in the domestic market going overseas. First year or two can be a bit mixed, and sometimes they can have initial, first steps can be positive. However, they've struggled longer term. I mean, Tesco would be which we're going to come on to. would be a key example of that, where it did try excellent operation in the UK, but then tried the US expansion and failed miserably. So I think that would be my main concern with Next. Of course, with the benefit of hindsight, I think would wish I'd invested a few years ago. But I think now with the valuation and that, it's less certain about what the future holds. And I think a lot of that will depend on overseas markets, and US, I guess, would be included in that. There is less certainty there, and I think more risk involved in buying the shares now. So it's one that I'd be keen to watch and obviously hope it does succeed, but I don't think it's one that I'd be buying shares in right now.
I agree. You did mention it, but yeah, so in terms of the share price since we started covering it, so if you look at the graph over 5 years, it's up 86%, excluding dividends, which I think previously were quite a bit better because the valuation was lower, so you might have got a slightly better yield. However, it took a dip in 2022, and since then it's actually up 122%. So if you'd bought it in 2022, yeah, you could have got it below £50 a share. However, I think the issue has always been, when we first started covering it, there wasn't really that overseas side of the business. I think there was a distribution side in terms of that distribution network that they were licensing out, but the overseas side wasn't really there. And the issue was it was so saturated in the UK, or it seemed like it, that although it was a fantastic operator, it's like, well, what levers can they still pull? Because it seems like they're on every high street. Their online sales as a proportion of total sales is ridiculous, and probably like 10 or 15% above the next best retailer. So where do they actually go from here? And I just would never have expected it was a kind of business that would have done well internationally. I think now it is a different proposition. If you think it is the kind of business that will do well internationally, which so far it seems to be, then yeah, I think you could still do very well on it at 17.5 times earnings. However, we have seen, this is maybe a bit of an unfair comparison, because Next is fundamentally a better business than ASOS and Boohoo ever were. But we have seen previously these retailers try and go overseas, and it's maybe, it's maybe not worked. I guess with Next, it's a bit better because they're deliberately targeting markets that they can service from the UK. And if we take Boohoo, for example, one of the issues was they invested a load into infrastructure for the US, and then there was no demand for it. So at least Next wouldn't have that issue. But yeah, I just think if I'd known what was going to happen, obviously it would have been a great stock to buy. I just never would have expected the international side to be. I didn't think Next was that kind of brand. I'd always assumed it was a UK only brand. But yeah, good to see it doing well.
Okay, on to AO, a company from your hometown, Sam.
Absolutely, and the founder went to my school, but I think we didn't overlap, unfortunately. Same with Ian McKellen, actually, for anyone who's interested. And also the captain of the sister ship of the Titanic, but he is less talked about because it didn't sink, but arguably, well, definitely did a better job. So AO, it's the white goods retailer, although it's all online. They have come out with their half-year results, and total revenue was up 14% to 586 million. Business to consumer revenue was up 12%. Operating profit was up 7% to 18 million. So we did cover Currys last week. We talked about what a tough industry it was. Just for context, operating profit for AO is 18 million, and that's on total revenue of 586 million. So that's a pretty narrow margin. And when you think about it as well, AO doesn't have that infrastructure and all the stores that Currys have. So it just sort of, I think, reiterates just what a tough industry it is with those margins. Profit before tax, that was up 10%. Basic earnings per share was up 15%. And free cash flow was up 306%. They had market share gains across all key categories. They've continued their profit progress, which they've said was achieved despite inflationary headwinds of about 4 million from the national minimum wage and national insurance cost increases. They now have 200 million of total liquidity at the period end, with free cash flow of 57 million. And that's up from 14 million a year ago, which they've said is driven by strong operating performance and a temporary improvement in working capital. There's an ongoing share buyback program of £10 million, with 1 million purchased by the period end. However, that is on a market cap of 624 million, so pretty negligible. Really, it's just a small dividend that you get in the form of a buyback instead. And it's not going to meaningfully reduce the share count. I actually think as well, if I was a shareholder, I'd probably rather have a dividend at those levels, and just it would be for me to decide what I did with the cash. They have launched Switch 24, which is a first-to-market proposition on the latest Apple headsets exclusively for 5-star members. So you would get an iPhone 17 for only £17 a month, upgraded every 2 years for the latest model. And they've continued investment in their 5-star membership proposition through compelling discounts across all categories. So I'll just see how they make money on that. Because you'd think offering an iPhone for 17 quid a month as an annual membership fee. So they pay, it's only 40 quid a year to be a 5-star member. And in exchange, they get exclusive deals and discounts. They have highlighted their globally leading Trustpilot rating of 4.9 out of 5 on 850,000 reviews. And their post-pay mobile business is now run rate profitable. And they've made significant progress in integrating, streamlining, and simplifying Music Magpie. Are you familiar with Music Magpie, John?
Is this where you get old CDs?
Yeah, so I think I don't know if I've never used it, but I remember the adverts and stuff. But you send your old CD in, and they'd send you sort of 50p. It's kind of like CEX, but online.
Okay.
So they bought that, and they bought that quite recently. But at the time they bought it, it was making losses of £6 million a year. They're now forecast to get that down to £2 million a year. Okay. And they've got an exit run rate of break even. And they think there's significant untapped opportunity. I'm a bit skeptical about this one.
Yeah.
But we'll see. I mean, if it's losing £6 million a year, I can't imagine they've paid a lot for it. It's not an acquisition that strikes me as a no-brainer. But I guess we'll see how they do with it.
How exactly... I suppose they're making a loss, but what's the theory in terms of making money from this? Like, how does it work now that everything is basically digital?
Good question. So I think it was partly to do with that refurbished technology. So because a lot of it's like they won't just do the CDs and stuff obviously anymore, but they'll do, it's a bit like a CEX where you can go in and get like a secondhand mobile phone and stuff.
Okay.
So I guess they can use their networks, and the idea might be that if you can get that on the website as well, rather than just going to AO for new stuff. And then if you want something that's secondhand or refurbished, you end up going to CX instead. You can whatever. So I think the CDs they're probably not doing well on, but I'm guessing the idea is sort of like those secondhand sort of maybe white goods as well. I guess you can try and use it for that. If you've got like a washing machine that you sell and it's faulty and you end up getting it back under warranty, you repair it and you've got that kind of infrastructure in house to sell it refurbished, so you're not losing as much money on it.
Sure, that makes more sense.
They've aimed to become the destination for electricals.
Oh, fine, I see. So it's not the traditional Music Magpie.
I think they're expanding. I think it's more like a CEX model now. AO anticipated cost savings by feeding its high-volume trade-ins from electrical sales into... So they'll let you trade in your old stuff as well. So I think the idea is, again, they plug that into Music Magpie. You know, if you trade in your TV and you give them sort of a rubbish old one that's 10 years old, they've actually got somewhere they can try and go and sell that.
Yeah.
So it does make sense with the cross-selling, but I wouldn't say Music Magpie is actually more or less unattractive than the initial business, I guess. And then they've said, we are pleased with the group's progress in the first half. We're trading slightly ahead of our previous expectations. Despite the inflationary headwinds, in our pre-close trading statement on 15 September, we updated our profit expectation to between 45 and 50 million. Given continued positive trading since then, we now upgrade our 2026 profit before tax guidance to be around the top of that recently narrowed range. And in terms of actually, it's probably worth looking at it over the last 5 years, which we can now start doing quite nicely because we've got that massive drop in 2020 in a lot of these results anymore. So the 5 years becomes more useful. So revenue has actually been decreasing year on year over the past 5 years. And then it started to go up again in 2025, 10%. But 2022, it was down 17%, 16%, 23, 9%, 24. Gross profit, in fairness, that's actually held steady. So they seem to be doing better with less. And they have been getting the operating expenses down. The operating margins improved slightly, but again, very, very tough industry. But it's not a business where you look at it over 5 years and you can sort of see where that growth is. Which brings me to the valuation. So it's now trading at a PE ratio of 65 and has a no dividend yield, but they've got that small buyback we mentioned. In fairness, if you look at it on a forward PE, which is probably better, it's a forward PE of 16, which is probably more where you'd expect it to be. But I just think if you look at the history of it, you look at the industry, I know they're trying to, it seems like they're trying to do stuff with sort of Music Magpie and the membership scheme and stuff. And I think they're pulling all the levers they can reasonably be expected to pull, and possibly doing a bit more than maybe Currys seem to be when we covered them the other week. So of the two, it probably is the more exciting business, but it's just still not an industry I'd want to touch. What about you, John?
Yeah, I think it's a good operator, but such a difficult industry, intense competition, wafer thin margins. Yeah, it's just, I wouldn't go near it.
Right. So should we move on to a better retailer?
Yes, so it's in fact the UK's largest retailer, which is Tesco's, and obviously the largest supermarket chain in the UK. They had their Q3 trading statement out last week, with Tesco's like-for-like sales rising 2.9% over the 19 weeks to the 3rd of January, excluding fuel. This was slightly below market forecasts, largely due to double-digit declines in tobacco sales at its wholesale business Booker, as well as weak sales in Central Europe. In the UK, market share rose to hit its highest level in over a decade, helping volume growth outpace the broader market. Full-year operating profit guidance has been moved to the upper end of its previous £2.9 to £3.1 billion range, and free cash flow guidance remains unchanged at between £1.4 and £1.8 billion. And the shares fell nearly 5% in early trading. In terms of valuation, Tesco has a market cap of £26.4 billion and trades at 14.6 times forward earnings, with a prospective dividend yield of 3.4%. I thought this was slightly disappointing, but if you look at the consistent growth that they've had since COVID, and at times that's been sort of artificially, I guess, propped up in the sense that when other stores were closed, Tesco's was considered essential, so it managed to stay open. And I think other things that we've seen which has really helped Tesco is that its competition, so Morrison's and Asda particularly, were taken private equity, loaded up with debt, and therefore have been less competitive. Meanwhile, at the same time, over the last few years, with Dave Lewis taking the helm, is left now a couple of years ago, but taking the helm and really getting back to basics with the business and making it the best operator of all the supermarkets. They've been able to compete at the bottom with Aldi and Lidl and doing price matches with them, with their great buying power and also the integration of Booker too. But they've also been able to compete at the higher end. They've grown the finest range. And then those kind of in the middle at Morrison's and Asda, they've been able to, I guess, outprice them too. And particularly as they've been loaded up with debt in their private ownership, they've been able to take market share from there. So it's got to market share now of around 27, I think it's 27.3%. So I think if you look back at the last 5 years, really fantastic. I don't think these numbers are terrible by any stretch, and we'll come on to look at Sainsbury's later. Very, very similar picture. I guess they just haven't been quite as good as Tesco's have been kind of consistently putting up over the last few years. For me, as a former Tesco shareholder, I think it's a fantastic business and in a much better place than it was. If you look at it, though, the valuation has increased. So I guess when you're seeing these numbers and it's just 2.9%, it's a bit down. Inevitably, you get more of a market reaction to that. I think in the longer term, I think it'll probably continue with its dominance. I guess the question, if you're more of a growth investor, is where does growth come from? Yes, I suppose it can, grow the market share a bit to a degree, but it is limited. It's a business that has tried international expansion in the past. It's been to Thailand, it's been to the US, none of which have been I would say particularly successful. They have failed and they've lost a lot of money there. They are the best operator in the UK, but that does limit the growth because it's a very much a saturated market, albeit with taking small amounts of market share from some of its competitors. The other thing I think is if you're an income investor, where are you getting the best dividend? And Tesco's, I think, going back, a year or two, that dividend yield was probably more around the 4 to 4.5%, so a bit more attractive there. But now it has come down a bit, particularly as the shares have done well. And at 3.4%, there are I'd say much better dividend plays around. I think it's a quality business, but I wouldn't be drawn back to sort of buying shares in it, because you don't have a huge amount of growth there, and also it's not rewarding you with a huge dividend either. So that's probably where I would be sitting on Tesco's, but I wouldn't be particularly down on these results, quite honestly, given what we've seen in the last 5 years.
The 2.9% sales growth is not great, but the UK has been dragged down by Central Europe, so it looks like this is just for the Christmas period, but UK was 3.2% and Central Europe was 0.8%, so it's dragged it down sort of below 3. I think if they're still gaining market share, that's really the main thing, because long term, that's kind of where the growth in the value of the business is going to come from. It's going to be that market share. So I think operationally, I don't think it's been a terrible period. I think the issue is, like you said, the valuation just isn't really as compelling as when it was at 10 times earnings and you had a 4.5% dividend. And I wouldn't say, like, the business has operated well and they've got rid of the Thailand business, and they have really taken the most, like you say, of that opportunity that's come from Morrison's and as they're getting acquired. But I don't know if it's such a good opportunity that I would want to pay nearly 15 times earnings for it and get a lower dividend yield than I could get interest in the bank, because it is probably, for me, more of an income stock than a growth stock now, because they're pretty saturated. And whilst there might be some more market share gains, I don't think it's going to significantly move the needle. So yeah, I just think it's a really good business, really good operator, but just because of that valuation, which isn't Tesco's fault, I'm just not sure where it would actually sit in someone's portfolio now.
Yeah, I would agree with you there. Yeah. All right. On to our next company, Sam.
Yes, Cranswick. So, company we've covered before. They mainly sort of do kind of pork and poultry products, and they supply basically all of the big UK supermarkets. They have come out with, this is from end of November, but we're going through a bit of a dry spell for companies reporting at the moment, so we've gone back to look at them. So they came out with their half-year results for the period ending 27 September 2025, and revenue was up 10.4% to 1.468 billion. Operating profit was up 24.6%. Profit before tax was up 21.1%. Earnings per share was up 21.1%. If we look at the adjusted results, the main reason for the difference between the statutory results and the adjusted results, it is to do with valuation movement on biological assets. I can't say that's something I really have enough expertise in to know whether the adjusted or the statutory are more useful. However, that difference, it's only kind of 10% anyway. But yeah, in terms of the adjusted results, the group operating profit was up 13.5%. The operating margin was up from 7.5 to 7.7%. Profit before tax was up 9.7%. Earnings per share was up 9.3%. Return on capital was down from 18.7 to 18.2%, although that's still very good. Interestingly, net debt's gone up a lot. So net debt excluding lease liabilities is up from 0.9 million to 127 million. Including lease liabilities is up from 107 million to 272 million. So one of the things that has increased it is acquisitions. So they've acquired during the year James T. Blakeman & Co. in May 25, and that was for initial cash consideration of 30.2 million. So that's a chunk of the debt. And they've said the acquisition will enable the group to expand its offering in the sausage manufacturing market, bringing more raw and cooked sausage capacity to the group. And they've also got total capital spend of 89 million, which is basically kind of all of that operating profit. And included in that, the pipeline for projects or major projects that are ongoing, £30 million expansion of 2 added value whole poultry sites now completed, £25 million Worsley hummus and dips facility nearing completion, 13 million investment in throughput expansion ongoing, 100 million whole pork primary processing site expansion progressing, 14 million investment at the Lincoln pet food factory or facility, 25 million spent on farming and feed milling during the period, Of that revenue growth of 10.4%, like-for-like revenue growth was 7.9%, and that was underpinned by 7% volume growth in the UK food business. Poultry revenue is up 18.5%, reflecting new business wins, and now represents 20.9% of reported revenue. Gourmet products revenue increased 15.9% with a strong contribution from Blakemans, which is the company that just acquired earlier. Pet products revenue was 13.6% ahead, reflecting expansion of the pets at home relationship. Free cash conversion was 89.9%, following record capital expenditure and acquisitions. And they said the increase in net debt from 0.9 to 127 million pre-leases reflects record capital expenditure, the Blakemans acquisition, and working capital expansion from new long-term strategic partnerships and strong Christmas stock build. And the independent veterinarian review of pig farming operations is now concluded, with summary report published and recommendations now being actioned. I mean, we've talked about this before, but Cranswick, it's another good operator. We've got quite a lot this week. But yeah, if you look at them over 5 years, if we go to the income statement over 5 years, revenue's grown from 1.9 to 2.72 billion, and that's up every single year. So for the last 5 years, it's up 13.87%, 5.8, 15.66, 11.9, 4.77. Gross profit, that's up over the period. That's grown each year, 21%, 4%, 7%, 24%, 12%. Operating margin, that's improved over the period from 6.19 to 7%. So it's a business that's growing and it's getting better. Earnings per share, that's up quite a bit. That's up from 1.93 to 2.63 a share. Dividend per share, that's up from 70p to £1 a share. So yeah, really good operator, I think. And it's one that I think we've come to appreciate the more we've covered it. In terms of the valuation, the business trades at a P of 18 and has a dividend yield of 2%. I think for me, the issue I've got is probably the same one every time we cover it. I think it's a really good operator, really good business. There's not really anything in there that I would disagree with. I know the debt's gone up, but if you look at the debt as a proportion of revenue, and well, not revenue, that's a bad example, but if you look at the debt as a proportion of like operating profit, it's not at a level where you'd be concerned about it. You look at where that debt's being used for, it's all pretty sensible. It's not being used to just fund a dividend that's unsustainable or anything like that. It's been used for smart acquisitions, improvements in the facilities. I think the issue is, although it's a really, really good operator and a business that continues, I think, to impress and perform, I just think at 18 times earnings, although the growth rates are quite good, they're quite consistent, you can probably do better. So I think it's still, the opportunity cost is the issue, but it's a really good business. But, if you compare it to Next, for example, you can get Next at the same price. And I know we've got our concerns about Next, but I would probably be more comfortable with Next in the portfolio than Cranswick. It's just that valuation, really. But in terms of the business performance, absolutely no complaints. What about you, John?
Yeah, no, I would agree. I think excellent operator, and it does continue to deliver. It is on the expensive side at 18 times earnings. In terms of other concerns with the business, I don't know. I'm by no means an expert with this. I don't know if you had closer alignment either with the rest of Europe or you had some sort of US trade deal that included agri-foods, how much that would impact on Cranswick. I suspect it probably wouldn't be a huge amount, but that would be one slight concern there. But otherwise, I think it's more of an opportunity cost argument when it comes to Cranswick. But it's an interesting one, certainly, to follow, and obviously hope it continues to do well.
Should we move back to the supermarkets then?
Yes, okay. So we're on to the second biggest supermarket in the UK, which is Sainsburys, and they had a Q3 trading statement out last week with them having like-for-like sales growth of 3.4% in the third quarter, excluding fuel. Growth was driven by a 5.4% uplift in grocery sales as the group continued to gain market share. Its premium Taste the Difference range grew at a faster pace of 15%. Sales at Argos missed expectations, surprise, surprise, falling by 1% as higher volumes were more than offset by lower average prices as consumers steered clear of the bigger ticket items. General merchandise and clothing sales at Sainsbury's also missed forecasts, slipping by 1.1%, and full-year underlying operating profit has been maintained at more than £1 billion. Free cash flow guidance has been upgraded to more than £550 million, previously guided at more than £500 million, and the shares were down around 4% in early trading. In terms of valuation, Sainsbury's has a market cap of £6.95 billion and trades at 13 times forward earnings with a prospective dividend yield of 5%. I thought these results, we can compare them directly with Tesco's, so they were slightly better in terms of like-for-like sales, and it was encouraging that they had a 5.4% uplift in grocery. Also interesting with the Taste the Difference, which has the higher margins, and you wonder whether some of that market share is coming from the upper end, so more your sort of Waitroses and M&S's on that sort of Taste the Difference. Could also be that some of their existing consumers are sort of trading up, which is good. We note that Asda, they have been losing market share as previously. So their market share, their sales were down, interestingly, 6.5%, and their market share had fallen from 12.4% to 11.4%. So presumably Sainsbury's being one of the beneficiaries there. I think, again, with Sainsbury's, there's been a longer turnaround story with it, and it's more recent. I think Tesco's had Dave Lewis coming in, and Sainsbury's, that's been a bit slower, but I think well on track. It's interesting because they've got Argos within their portfolio. That has been a disappointment. They paid around £1.5 billion for it, I think getting on for 10 years ago now, and that's just basically been a disaster. I think it's now mooted to be worth more under or around the £350 million mark, and that may be spun off. I think one of the things that is a bit more attractive about Sainsbury's, certainly if you're an income investor, is that it's got a chunkier dividend. It's currently about 5%, and it's also less expensive than Tesco's, which was more the 14.6 times earnings compared with 13. So I think if you're an income investor, it's maybe, something to consider. But overall, I think there are more attractive businesses on the FTSE, and I wouldn't be buying shares in Sainsbury's as a result. Sam, what are your thoughts on these results and Sainsbury's as a business?
I don't think the results are that different from Tesco's. It's a bit better, but it doesn't have Central Europe dragging it down like Tesco's did. So if you factor that in, they're pretty similar. It does have, however, Argos dragging it down. I think at 13 times earnings and a 5% yield, it's not terrible. I think you can make an argument for it, especially with that continued kind of market share gain that they might be getting from Asda and Morrison's. I think Tesco's is the better business, but I probably would prefer the Sainsbury's valuation, I think, especially with that dividend yield. So I actually think of the two, I'd probably go for Sainsbury's at the minute. What would you do? Would you just go for Sainsbury's?
I probably would on the valuation. I think I'd agree with you that Tesco's is the higher quality business, but on that valuation, you also wonder when if they do sell Argos, whether you get sort of special dividend and return the cash to shareholders as well.
Although I think in fairness, Argos inside the Sainsbury's stores, it's not that sort of click and collect for sort of the white goods and stuff like that. It's not a terrible idea, because I'm not sure what they'd actually get for Argos now, other than Mike Ashley, who'd actually want it.
The
problem is they're all now integrated into the Sainsbury's stores, so they're kind of stuck together.
Yeah.
You don't really get standalone Argos stores anymore, do you?
No, you don't. You don't, absolutely.
So I think they're kind of wedded to that. I think of the two, probably I prefer Sainsbury's on valuation. Should we move on to our US company then?
Yes, and one that's sort of, would you say, fallen from grace?
I think it has. I've bought it, so that's usually a sign. So Nike, I'm sure it needs no introduction. They have come out with their Q2 and half-year results for the quarter ended and period ended November 30, 2025. And revenue was up 1% to $12.4 billion, and all these figures are in dollars. Gross margin was down 6% to just over $5 billion, and the gross margin has now dropped from 43.6% to 40%. If we look at the results for the quarter instead of 3 months, it's actually the same. Revenue at 1%, gross profit down 6%. Gross margin for the 6 months as a whole was a bit better at 41.4%, but still decreased by about 3%. As a percentage of revenue, total selling and admin expenses increased. They've increased slightly in the quarter from 32.4% to 32.5%, and in the half, they're down slightly from 33.6% to 33.4%. And the income before income taxes is down 29% for the quarter and the half. If we break down the revenue by region, for North America, for the quarter, revenue was up 9%, and for the half, it was up 6%. For Europe, Middle East, and Africa, for the quarter, revenue was up 3%, and for the half, it was up 4%. For Greater China, for the quarter, it was down 17%, and for the half, it was down 13%. And Asia Pacific and Latin America, for the quarter, it was down 4%, and for the half, it was down 2%. And if we do it by product, footwear for the quarter was flat, and it was also flat for the half. Apparel was up 4% for the quarter and 7% for the half, and equipment was up 1% for the quarter and 3% for the half. Wholesale revenues were 7.5 billion, up 8%. Nike direct revenues were 4.6 billion, and these were down 8%. Elliot Hill, president and CEO, has said, Nike is in the middle innings of our comeback. We're making progress in the areas we prioritised first and remain confident in the actions we're taking to drive long-term growth and profitability of our brands. They've said the gross margin decrease, which is the main reason these results are poor, is due to higher tariffs in North America, which I don't think will come as a surprise to anyone. In terms of the valuation, the business trades at a P of 38. However, if you look at the P from sort of 2 or 3 years ago before it had these issues, it's a normalised PE of 17. That normalised PE, I would take it with a pinch of salt because firstly, there's no tariffs in that normalised PE, and they're probably not going anywhere for at least the remainder of this administration. But also, there is still a turnaround going on. This doesn't seem like a blip. It does seem like a business that needs an actual turnaround. But yeah, normalised PE of 17, and the dividend yield is 2.51%, and they have been increasing that dividend every year for over 20 years. As a shareholder, I'm probably lukewarm about these results. I think the revenue, the main thing is that North America revenue, at least that's stopped decreasing, and it's actually up a fair bit. Some of the other regions, China, I think that was always going to take a hit in the current environment. I think the tariffs, they can't do anything about. I knew that was an issue and I bought it. There's nothing in these results, to be honest, that's particularly inspiring. Although they're not awful when you kind of ignore the effects of the tariffs. But I think for me, it's more of I've bought it because it's down kind of 60% from the high, and it's Nike, and that I'm hoping at some point that the quality of that brand means that someone can come in and turn it around. Hopefully it will be Elliot Hill, but who knows? It's probably not that dissimilar to when I bought Disney, which I've not done well on, so maybe that tells you something. But it's really more for the quality of that business, and I think you don't get many opportunities to buy it at kind of a, quote, normalised PE of 17. So it might take a few years for someone to actually get to grips with the business and turn it around. But I just feel like it's the kind of business I've always wanted in the portfolio. So the opportunity's there, so I've gone for it. But there's not a huge amount in these results to inspire me, that being said. What about you, John, as someone who's more impartial?
Yeah, I recognise that it's a fantastic brand. It's certainly underperformed and needs a turnaround. When that happens, who knows? I guess there are some sort of early signs of it, but I think I'd want to see more before actually going in there. I appreciate by historic standards, it looks more attractive on a valuation basis. And am I right in thinking that Tim Cook has recently bought quite a few Nike shares?
Oh, I don't know. I'll check that. Yeah, he has.
Yeah.
Bought nearly $3 million of stock. Well, for him, that's...
yes.
Yeah. Well, he knows a thing or two about brands. In fairness, he's actually... So he's been on the board since 2005.
Oh, interesting.
I suppose if he's buying, that's maybe actually quite a good sign.
Yeah, no, absolutely. As a billionaire, 3 million is a pretty small change.
No, yeah, that's right. But it's bigger than my stake, I'll disclose.
Yes, absolutely.
I think as well, probably the other thing that's concerning is that I do still see the future of this business as direct to consumer.
Yes.
And that's decreasing.
Yeah.
We cover JD quite regularly, and we'll sort of complain about long term, well, you've got these direct to consumer, where are the sales going to come from? That's not happening at the minute. It's actually going the other way, but at some point you'd think that has to reverse.
Exactly you would do. And you think, having Nike.com and having Apple Pay, Google Pay, just being able to go on there, surely that is the model.
And maybe design your own shoes. It gives you the option for more bespoke options.
Yeah, I was going to say with AI as well, coming into the design and all of that, and then probably doing some augmented reality, seeing what they look like, on your feet, all of that kind of stuff. You would have thought it's only going to go direct to consumer, but could be wrong.
It'll be a while as well based on these results.
Yeah, that's right.
Right, so of the 6 businesses then, next, AO World, Tesco, Cranswick, Sainsburys and Nike. Which do you like the most and which do you like the least?
Oh, it's a good question. With my money, I would probably, despite me being lukewarm on Nike, I'd probably go for Nike on the basis of the brand, the valuation, and I think the potential ahead of it. In terms of last, it would be quite easy. It would be AO. I think that industry is just impossible. And they are doing well in it, but it's so tough. And at some point, you'd think that you can't necessarily still keep going with that.
So mine, I'd also go with Nike. I think if I excluded that on the basis I own it, I'd probably go for Next. I don't think it's as attractive as it used to be, but I think it's, excluding Nike, probably the best business of the 5 that are left. AO, I would exclude it, same as you, on industry. It's just not an industry I'd ever want to touch. But I think that you look at the things they're doing in that industry, there's not really anything else that springs to mind. It seems like they are a good operator, so it's not really AO's fault. They're just in an uninvestable industry.
Very good. Well, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.